The difference between success and failure in the stock market has nothing to do with your skill set. It has everything to do with your mindset. I'm Evan Lazarus, Chief Knowledge Officer and Mentor for T3 Live. I'd like to invite you to an exclusive trading education event in Charlotte, North Carolina on Saturday, March 16th. Attendees will learn what we believe to be the 5 biggest mistakes that plague the average trader and how to overcome them, with a specific focus on trading psychology and risk management. Reserve your seat at t3live.com or call the number below. I look forward to seeing you there.
How you doing, everyone? John Darsie, Editor-in-Chief, here to bring you the daily recap in Scott's place. We had a little bit of a quiet day in the market today after the gap up. Maybe a little bit of exhaustion after the celebrations yesterday about Dow all-time highs and all that type of stuff. But we had Dow all-time highs, which is a major milestone for the market, but you didn't get the kind of exuberance that sometimes you might think would accompany that type of milestone. I think everyone sort of acknowledges that this market still has a lot of hurdles to overcome. The world economy is not yet out of the woods in terms of the European debt crisis, and we still have several things to overcome this year in U.S. markets and in U.S. politics. We have a debt ceiling debate coming up in May again. The sequester continues to drag on. It doesn't seem like the market really cares much about the sequester, but I think everyone sort of acknowledges that you shouldn't be so exuberant and so aggressive about buying highs right now, especially all-time highs, multi-year highs for the S&P, all-time highs for the Dow. I think right now, there's a little bit of profit taking going on, but it's nothing major that's really a cause for concern. I mean, markets did today end up after all. The Dow and the S&P were slightly positive, while the NASDAQ lagged a little bit. But I think some rest would be healthy. We'll wait and see what this action that we saw today leads to, but I don't think it's anything right now more than just healthy rest. What you did see is we'll take a look at the spider chart real quickly. If you take a look here, you see what I talked about. We had that gap up this morning, some follow-through strength after yesterday's big breakout. We had a gap and go yesterday. And today it's just sort of some digestive action. Like I said, nothing to really be concerned about. It's healthy to see a market rest at upper levels and not run away from everyone before they can get involved. So perhaps we can get a shallow pullback or a nice pullback to retest that breakout level before heading higher, which I think would be a level that people would be interested in buying. I think one thing that gave us clues today that the market could be due for a little bit of rest was some weakness in the tech stocks that had been leading the market higher. You saw Google, LinkedIn, Netflix, those are the stocks that have really been leading this market over the past few weeks after earnings. If we go ahead and take a look at the charts, we can take a look at Google first. It's sort of been the best in breed tech for a longer period of time. And today, obviously, you see that bar, a little bit of exhaustion. It's got this open gap from yesterday that you could see it test. So I'll definitely take a look at that level and measure your trades based on that level and use that as a pivot, which is something that Scott talks about often. I take a look at LinkedIn. Yesterday, even LinkedIn showed signs of exhaustion. It followed through today, and I think that's a monster run that LinkedIn's been on since earnings. And I think it would be definitely healthy to see LinkedIn fill back a little bit, maybe let these moving averages play catch up. Maybe even if it were to test the 21-day moving average, that wouldn't be game over for LinkedIn. I think that would be healthy action. It's trading at a very rich valuation right now from a value perspective, but the price action continues to be bullish, and that's what we defer to. That's what we usually defer to. And then you take a look at Netflix. Netflix is one that, with Google and LinkedIn, I wouldn't necessarily be looking to short those. I mean, some traders who are counter trend guys could look to fade that strength in Google and LinkedIn for a cute type of trade is what Scott calls it. But Netflix, I think, could be a little bit more calculated. As you see the 8-day moving average curling down, sort of containing the stock right now. And I think it feels like Netflix is just hanging on to this little pivot support area by a string. I know Laz been looking on the short side of Netflix, and I think it's definitely an interesting setup if you're looking to play or looking to fade some strength in some of these leading type of stocks that have had huge runs. I mean, this run for Netflix from 100 almost up here to 200, almost 100% move. That's a monster move for Netflix. So I think, trying a cute short there's nothing wrong with that every once in a while, even if, it's not the bedrock of your strategy. We also saw the banks actually perform well today, which is a good sign for the market. If you take a look at the XLF here, the banks have been leading the market for the greater part of the last year, 6 months especially, as you've seen the European debt crisis sort of go into the periphery a little bit and get out of focus. And today, this is constructive action for the banks to see rest it closed above yesterday's high. It was, which is very constructive. And like we've talked about many times in the past, you're sort of seeing rotation within the banks. So, at some point you'll see Goldman Sachs lead. At some point you'll see Bank of America and Citigroup, that caliber of bank stock lead. And it's interesting. You see, sector rotation, but you also see stock rotation within sectors. And right now you have JP Morgan leading. Goldman had a little bit of a sharper pullback in some of the others when we saw that big sell-off last week on Monday, and it's still a little bit below pivot highs. Bank of America, like I talked about, is sort of waking up. You've seen that rotation. Scott has been long Bank of America. It's been the one he's chosen to play, and now Bank of America is back above all of its moving averages, so very constructive day today for Bank of America. Facebook is one that we're going to talk about. Scott was mentioned heavily on CNBC yesterday on Jim Cramer's Mad Money program, talking about what he thinks is a very bullish long-term setup in Facebook. We're going to take a look at that. Maybe the monthly is a little too far to zoom out. We'll go to a weekly here, make it easier to see. But you see this sort of long-term cup and handle pattern. I can see Scott already drew it. You see a long-term cup and handle pattern forming in our 2012 predictions for Scott. We talked about a cup and handle that formed sort of right here with the handle right around here. And we got the move that Scott was looking for. Sorry about that. We got that initial move based on our 2012 predictions up to this level a lot quicker than we had anticipated. And Scott talked about sometimes if you come in with a plan, you get rewarded quicker than you expect. But now you sort of see Facebook forming a cup and handle pattern on a more macro sense. And that's what Cramer talked about last night using Scott's analysis. And the measured move, the full measured move from the depth of the cup out of this handle would take you back to that $38, $42 range that Facebook traded on the day of its IPO. I mean, the IPO is obviously a huge disaster, but you've sort of seen Facebook sort of pick up its game a little bit in the mobile space, which is what's really important for Facebook and what it's really not done well in the past. So I think you could really see Facebook ramp up today. If we go back to the daily, I was taking a look at a more macro chart right there, but today it did not act well, and it sort of looked over the past few days like maybe it was ready to go and break out of that descending channel that we've seen since earnings. But today it showed that it's not quite ready. It was rejected at that 21-day moving average, as you see right there, and it may take some more time for Facebook to get out of that descending channel and ignite that cup and handle pattern if we do see it ignite. One thing I'll also talk about, I keep touching the microphone there accidentally, sorry about that. Gold looks to be sort of finding its footing. It sold off hard on that those Fed minutes a couple weeks ago when the Fed sort of started to sound a little bit more hawkish. But it looks like it could have made a higher low here. I think it's something to take note of. We're still in a very inflationary environment. You have the Federal Reserve, continuing to print and do QE. They're thinking about a possible exit plan for QE, but it's still something that's on the table and that is going on right now. And then you have the currency wars and Japan continuing to aggressively devalue its currency. So you see gold potentially making a higher low. And I think if you're looking for some protection, in case you are one of those people that believes that a lot of the stuff the Fed and world central planning is doing right now is a little bit dangerous and destabilizing for markets in the world economy, I think right now is a good spot to potentially buy some gold as a little bit of a protection against some of the ills that may plague the world economy in a longer term basis. We'll also take a look at another commodity. We'll take a look at oil. You've seen a sharp sell-off in oil that's driven the strength in the transports. You see strength in the transports, according to Dow theory, is a precursor for strong economic growth and potential more upside in the markets. And you've seen this drop in oil really fuel that. And oil looks like it's trying to find some footing as well, sort of like gold. You've seen a couple of these candles close a little bit like I said, it's trying to find its footing and find a bottom. So keep an eye on that to see if potentially if oil's able to rally again, if that weighs on the transports and maybe starts to weigh on the broader markets a little bit. We'll take a look really quickly too at the dollar index, the UUP. We don't look at currencies a ton here. We don't really trade currencies very heavily, but I think you'll note this strength the last 2 days after bottoming out before the open yesterday in the UUP. You've seen the dollar bounce, and it looks to be set to challenge these pivot highs right here. So if we do break above that, that could put further pressure on the markets, as the markets usually trade inverse to the dollar. So that's something I would definitely keep an eye on too. And then we'll take our obligatory look at Apple, which today proved that it's not your daddy's apple. It's a new apple, and it's a bad apple, and one that you can't really trust on one day up. It really has a tough time recently getting any sort of follow through. After perking up, everyone gets excited when you see one day up an Apple. They're worried that they maybe missed the bottom, and they aggressively want to get in. But then once again today, you saw it fail. And I think, as I've said many times in my appearances on here over the last couple weeks, and even a few months going back on the blog, that Apple is just something you should put off your radar right now and really focus on other things that are more compelling. But that'll basically do it for today's daily recap. It was a quiet day in the market, some healthy rest. Maybe you saw people head home early as weather is approaching the Northeast again, as we've seen a few times this winter. But everyone stay safe out there. We'll see what today's rest leads to, and we'll see you tomorrow on the virtual trading floor. Have a good day.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.